I'm Matt Bishar with REIT.com, and I'm here in New York City for REITWeek 2012, NAREIT's Investor Forum. Joining me is Trevor Bond, President and CEO of WP Carey & Co. So Trevor, with so much uncertainty still going on in the market, what can a global owner and operator of commercial real estate like WP Carey do to shield itself from some of the uncertainty?
Well, the epicenter of the global turmoil is, of course, Europe. And the way that WP Carey thinks of it in the immediate sense is we're a dividend-paying stock, and so in U.S. dollars. And so we use a variety of hedging techniques to cover that. And we're pretty well covered for the next 5 years on that. But to look at it more broadly, I think that the real problem that exists worldwide is, and particularly in Europe, is over-leveraging. And what we're trying to do is worldwide is delever. And so the real source of the crisis is too much government debt. And so then if you really think about the true risks to an investor, I think that the bondholders, the holders of the sovereign debt, bear much more risk. Now, by contrast, we invest in companies. We don't buy sovereign debt. And so I think that the real risks for any real estate investor would be towards the risk of contagion, sort of the broader risks that would that the economy would be exposed to, so that if you have a deeper recession, for instance, then really all of us, including here in the U.S., are at risk. Now, the way that we mitigate that, we are primarily a net lease company, and that affords us the advantage of long-term leases, so that a typical lease would be 15 to 25 years. And when you think back on the cycles that we've experienced just in the world economy over the last, say, 18 years, you see that as long as we've made the right decision with respect to our tenants and they're continuing to pay the rent, it actually doesn't matter that much what's going on in the broader economy. Big assumptions there. We have to do our homework on each company and make sure that they can continue to pay the rent. The other things that we can do are really just the same things that any real estate company would do to mitigate risk. It's to diversify. We diversify by country as well as by product type and by tenant, obviously. And then we also diversify within the tenant itself. So any given company, we'd like to see them diversified by country, so that we're not dealing with any particular focused risk for any particular country.
And with that said, picking up on that topic of diversification, where are you seeing some of the best market conditions right now? Well,
interestingly, the United States seems to have won what's called sometimes the battle of the uglies. I mean, we have our problems, clearly, particularly with respect to our political gridlock that we experience, and we're still at some risk of that, particularly in this election year. But by and large, the United States is doing well relative to the rest of the world now, and employment's starting to creep back. We're still a manufacturing powerhouse. As a company that provides long-term build-to-suit financing, we're starting to see, and we expect to see, more build-to-suit opportunities from companies. It's not so much dependent on job growth as you would have, say, in your office market, but logistics facilities and manufacturing facilities will benefit from this trend towards reshoring or onshoring that's starting to occur. The United States has cheap, abundant energy. Many of the states have done sort of what the peripheral Eurozone economies wished they could do, which is to reform or have flexible labor practices, and so that has helped some states really turn their employment around. So I think the United States is looking good. We're also looking at, obviously we continue to look at the growth markets of the world, but we've been very cautious about taking the first steps forward in some of the markets that have a little bit of volatility. So Brazil and India have been favorites of investors for some years. We've been very cautious about investing there, and I think that we're glad we've been cautious because you've had some depreciation of their currency and some political instability. But South Korea is looking pretty good. We've seen some good opportunities in Japan as well.
And you touched on Europe in an earlier answer. Are there markets or regions that are just looking too risky right now, or areas where you've even pulled out of?
No, we haven't redlined. We don't take that approach. I think we look at each individual investment, and because we're looking at a company, we're open-minded. We don't like to waste a lot of time looking at things, but we're open-minded. We look at the business and its prospects, and we haven't redlined anything. But that said, we're extremely selective now, and we also have to we have an eye towards balancing our portfolios so that our exposure is not tilted too far in any direction. No, I think we would just really, most of the time, it's how you underwrite it. And so if you underwrite the risk and you stress it and see how it will do, even in down scenarios, I think we would continue to look opportunistically, because sometimes these sorts of environments afford us with the best opportunities.
Trevor, thank you so much for joining us.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.